All right. What is up, traders? What's up, tycoons? Super excited for today's video. Going to give you guys another market update. All right. There's a lot to take a look at. We're going to be diving into a lot of it. All right. And this tweet right here, I think, is really awesome and really sums up the year so far. Right. We see January, soft landing, February, no landing, March, hard landing, April, the credit crunch surely will drop us. Right. And then May, it's just mega cap tech. In June, it's a bull market with 4 exclamation points, right? This has pretty much been the narrative of most of retail and most of what you've seen online, whether it's on YouTube or, Twitter, different things like that. So I really like this tweet, and it definitely sums up, but we'll see what July and the rest of the year, what the narrative is going to be. But I really like that. Wanted to start it off with that. Now, be sure to smash that like button, subscribe to the channel if you guys are new. Diving into a lot of data today, okay? Whereas the largest stocks by market cap were previously the only area of the market to see significant gains, so far in June, small caps have massively outperformed. Okay, and we're going to dive into that a little bit deeper. But as this tweet was mentioning over here, it's just mega cap tech, right? That's kind of like was the bearish thesis that everyone was speaking of is, hey, this is not a good sign. Things are in trouble. It's just mega cap tech rallying. All right. But what are some of the driving factors, right? Like, how is this market possibly going up, right? And one big thing is going to be positioning. Okay. And so when you take a look at fund managers are missing out largely on this huge rally. Okay. When you take a look, they are extremely underweight in equities and US equities. So this means stocks, okay? And you can see here where they're overweight. They're overweight in healthcare. They're overweight here in cash. And, then technology right here. So, they are exposed to tech, okay? But when you look at it, they're really underexposed to stocks in general, right? And that is where we're at right now. And that's been the case for most of 2023 was that, okay, well, everyone had such a bearish thesis. It doesn't really make much sense to be going and be super long and overweight in equities, all right, in the stock market. And now we're seeing that, some people may have to play catch up, right? And so that's one of the forces that really could keep the market floating higher or just, no longer seeing that huge 20% drop, right? A lot of these fund managers have calls, they have tons of emails that they have to respond to from their clients saying, why am I missing out on this rally? Nvidia went up 20% overnight on earnings, and all I'm getting is 5% on my T-bills. What is going on? Why aren't you guys in any of these positions, right? So, that's something that you have to consider is there's still a lot of money, out there in treasuries and in bonds and just that isn't necessarily in the stock market. And I think that, we're now in the 6th month, right? So if people who are getting 6-month T-bills in the beginning of the year, those are reaching maturity now. And some of that money possibly could be heading into the stock market. Right. We've also seen tons of short covering, right? We actually had record amount of shorts. Okay. If you look at the short positions here, all right. And you take a look at, in the past few years, we saw record amounts of shorts here. And we've seen a lot of short covering, right? This next chart really highlights it a little bit better for you guys. So you can truly see this is short positions on the S&P 500 E-mini future. So these are not like puts and calls. This isn't the put to call ratio. And what we saw more short positions in the stock market on the S&P 500 E-mini futures than we saw in the 08-09 financial crisis. And what we've seen is some of those shorts have started to begin squeezing out of the market and really propelling things higher, right? So, these are some of the background forces really driving the market higher that most people aren't aware of, right? They're a little bit ignorant to. If we take a look here, the stock market is pretty much driven by earnings, okay? And earnings, really are what keep the market going higher over the long run. And we can see here that we're actually getting earnings upgrades and it's outpacing earnings downgrades, right? That's what we're seeing here recently in the market versus the last year, all 2022, we're seeing lots of downgrades, right? Downgrades. And here at the beginning of the year, or later in Q2 of the year, we're actually seeing earning upgrades outpacing the downgrades in the market. Now, when you take a look at different strategies, none of them have performed as well as the Nasdaq. Okay, so in red right here we have growth. In blue we have value. Value investors, all right, just take a look at the long run. Value investing, that's something that you hear a lot on YouTube, okay? And you hear people say, well, I'm a value investor, right? And oftentimes, it's just a way to, make themselves sound smart. But, the whole value investing style, there's a lot of misconceptions to it, and there's really no growth in those areas, right? And so you're just kind of holding the same thing, and there's not really any growth. So when you look at it versus the market, in the comparison to the market, it's going to outperform things that are growing. Now, in times where the market is very volatile and there's lots of fear, you're going to see that, all right, well, hey, those are time periods when value investing does well, because people will retreat out of growth, right? They'll retreat out of momentum, and what they'll do is they'll look for that safety net where, hey, this thing probably isn't growing much, but it's a good value company and it's going to stay relatively stable, right? And you can see that here very well, all right, in 2022, that value investing did very good in comparison to the S&P 500, right? These are all comparison charts, right? Ratio charts. So it's not actually the value of growth, but it's the value of growth compared to the S&P 500. And value and momentum, quality, low volatility, small cap, etc., right? And so really, it just goes to show that over the long run, growth is where it's at, right? Growth is outperforming the market on a very large basis. And that's essentially where you guys want to be at. If you're looking for long-term gains, is you want to be in some type of growth, right? You want companies that are going to grow in earnings and revenue, etc. Now, we see record-shattering inflows into tech funds, guys. It's passing the pandemic boom levels, right? It's absolutely insane right now, and really amazing to me, honestly. The type of flows that we're seeing, this is largely due to AI and being driven by AI, and the whole sentiment. And really since about December or January, me and a couple of people in the Discord, we've been talking about how AI is the new bubble, and it's the .com bubble forming right now. Now, does that mean that this is some big crash that the market is about to absolutely tank in the near-term future? No, the bubble is just forming, okay? It's been around for roughly 6 months right now, and we're 6 months into the AI bubble forming. And the reason that it's a bubble, okay, just like the .com era, is because people don't know how to truly value and put a value on what AI is worth, just like they didn't know how to do that with the internet. Now, the big difference from the .com bubble is that these are actually real companies, okay? When we're speaking about the big players, right? When we're speaking about Google's AI, when we're speaking about Microsoft and OpenAI's and ChatGPT, when we're speaking about Facebook, right? Ticker symbol Meta, right? And a lot of these other companies, these are established companies with already earnings, right? So it's not like there's some company that just formed and they're an AI related IPO. These are just companies that people are trying to figure out how to value, what AI is going to do to the business, and if it's really going to make, insane amounts of profits, right? And that's what the whole speculation is right now. So, people start chasing, these investments because they don't know what it's worth. They just want to get in on it because of FOMO, right? The fear of missing out. And they say, hey, well, if AI is right and AI is going to create these massive profits for all of these companies, I want a piece of it, right? And then so somebody else does that and they see it go up higher and they say, well, I want a piece too. And that's what happens is it keeps climbing, keeps climbing, keeps climbing. And we're seeing AI spread to things that people weren't really thinking they were going to spread to, right? Adobe has been one of our favorite stocks here lately, really ever since right around the NVIDIA earnings, right? Because now we're seeing AI go into things like Photoshop, right? And Adobe has a great brand, all right? And, people are very, familiar with the product. And, now they're integrating AI. They just reported earnings as well today after the bell, and the stock is up a very nice, percentage. It's nice to see them outperforming as well. And AI is just spreading to lots and lots of different sectors. And the big risk is that, all right, hey, well, what if eventually it gets massively overvalued, right? Because people don't know what to value it at this point in time. In the future, when, you know, the real value is established, all right, you know, then things may have to come down, or there may be some type of bubble that gets popped. But for now, we're witnessing the bubble forming, guys, and the bubble is just inflating, and who knows when it's going to stop inflating. Now, lots of people have been saying, again, that it's all big cap tech. It's only mega cap tech leading the way. So what this is the SPY RSP chart, the ratio chart. The RSP is the equal weight fund, all right, versus the S&P 500, which is, you know, largely impacted by big tech. And we saw a big drop in this. What does this mean? This means that the rest of the market is now playing catch up, right? And we're seeing that especially in the industrial sector, right? The industrials XLI has been absolutely crushing it. There's been a stock CAT, which is Caterpillar. A lot of people in the Discord have been crushing Caterpillar. John Deere, ticker symbol DE, has been performing well. STLD, Steel Dynamics. There's tons and tons of different ones. Right now on my watch list, I'm looking at TSCO, you know, and maybe that's a good trade. Maybe that's not. You know, that's for you guys to determine. Of course, none of this video is financial advice, just really presenting pure data to you guys, right? We're going to go ahead and take a look here and talk about some of this expansion, right? We're seeing this line go down. This means that the movement in the gains are now spreading to other sectors. So we have the S&P 500 here in the market breadth position to expand versus 2022's broad-based decline. All right. And you look at the percentage of NYSE stocks. This is the New York Stock Exchange above their 200-day moving average. And we're seeing it rise sharply here, and it's above 50. So over 50% of stocks in the New York Stock Exchange are above their 200-day moving average, right? So essentially, you know, a lot of people like to use the 200-day moving average as a gauge for, you know, hey, is something in an upward cycle or a downward cycle? And if you're using that metric, over 50%, over half of all the stocks in the New York Stock Exchange are potentially in a bullish cycle right now. Now, will that last? We'll have to see, okay? Now, this right here is the Russell 2000, all right? This is going to be your small caps, all right? And what we see here, all right, relative to the S&P 500, we've been seeing this underperformance, right? So we're creating these lows and these lower lows, right? So there's a low here, there's a lower low here. But on the weekly MACD, we actually see a low and then a higher low. And I speak about divergences often on my channel. So if you're new to the channel, maybe you just learned something new. And if you've been around for the channel, you guys know I love trading these divergences. IWM is definitely on my watch list right now as well. We're going to look to see, can the IWM catch up? Can the Russell 2000 catch up to some of this big cap and some of these other stocks that we've been seeing in the market here, right? We're seeing some nice potential rounded bottoms right here. Those are often bottoming signs versus a rounded top like this is a topping signal, and then you start to see the new trend. It's very possible that we are seeing, you know, some bottoming, some nice rounded bottoms up here forming, potentially leading to the Russell 2000 going higher, right? And this is a very long-based divergence that we've been seeing right here, and it'll be very interesting to see, do we get, you know, a nice move to the upside, right? Over here as well, the Russell 2000 above its 200 MA. All right. And this is the percentage of RET stocks above their 50-day moving average. Okay. And we can see here that this is on a steady incline, right? This is approaching 50% now. All right. So, you know, again, we're starting to see that it's not just big cap tech anymore. We're starting to see that rotation into different sectors of the market. All right. This is the percentage of stocks above their moving averages. All right. And in blue here is industrials, guys. Remember, I told you guys industrials have been killing it. Take a look at that XLI chart. We recently hit bullish price targets on XLI. We had a diamond top breakout, you know, a while ago in XLI, and industrials are just really, you know, still crushing it, right? You know, lagging behind there is at the bottom of the chart is what you're going to see is some financials, right? You're going to see financials not doing well. All right. You're also going to see things like real estate. All right. Not doing too well. Consumer staples haven't been doing too well. Is it possible we could see a rotation into some of these sectors? That's very possible, but you have to realize the market's very cyclical. So in 2022, things like energy, financials, staples, those were massively outperforming the other sectors. So it does make a lot of sense to see a rotation from what was, successful in 2022, not being successful in 2023, and the things that were unsuccessful in 2022, such as IT, information technology, different things like that, now you're starting to see those really start to outperform. Okay, it's just, rotation. It's not going to be that easy, right? You're not going to be able to just stick with energy and financials 1 year because they did good 1 year and then you just hold on to that forever. The market's not going to be that simple. They're going to try to trick you out of your money and confuse you guys. Okay, now something else that's really interesting here is that investor sentiment, all right, has really hit a historical low. And so markets, what they tend to do is, again, they tend to fool people, right? So when everyone is bearish, maybe that's the time to possibly think about going long, right? And now everything right now is at really frothy levels. When it comes to a lot of the big names in the market, the FANG stocks and things like that. But there are sectors, as we just saw and looked at, that are underperforming compared to some of the others, right? And maybe those are some of the things that you want to look into, all right, versus buying a top on something or something that's ran up already 100% this year or over 100%, as many stocks have. Again, when everyone is bullish, maybe it's a time to, have a little bit of caution. And when everyone is bearish, maybe it's a time to start looking for some deals, right? And try to look for what may be a good value, right? Now, this right here, okay, again, is just kind of highlighting the same thing. Okay, we're seeing the sentiment remaining stubbornly low, right? And what we can see here is COVID lows, right? So where we're at right now, guys, is extremely low, right? We're below the COVID levels. We're below the U.S.-China trade war, and we went actually below the great financial crisis, right? And a lot of this in my opinion, is because of social media, okay? Back in 2009, we didn't have the type of social media that we had today with, TikTok, Twitter, Facebook, Instagram, Snapchat, all of these different things, even things like Reddit, really just spreading a lot of the fear, right? So when everyone's fearful, it spreads like a wildfire. And when everyone's bullish, it spreads like a wildfire, and that's kind of just how things go these days with social media. Now, something that's really interesting, okay, is when you take a look at the S&P 500 average returns by the unemployment rate, okay, when it's 5% or lower, all right, the S&P 500 average returns are about 7.2% for 1 year. In 5 years, it's about 8%, and in 10 years, it's about 7.9%. So that's where we're at right now, okay? Just to be a little bit more on the cautious side of things, is the markets ran up a huge amount, right? But typically when you want to be buying and getting those really good values is when the unemployment rate is really high, right? And usually that's around times of recessions. We're going to look and see, if it's possible, if we're still going to have a recession. But the higher the unemployment rate, typically the higher the returns in the stock market. And right now, again, we're seeing extremely low unemployment rates. We're definitely at that 5% or lower level, but the market has definitely surpassed the 7% level right here. All right, now this is a really great chart to explain recessions to everybody. And so for all you people out there thinking a recession is starting, okay, look at what happens, okay? The market goes up, all right, and then we have this move to the downside, and this is where the recession starts. And then the stock market actually bottoms before the recession ends, okay? So that's something very important to realize, okay? Is, the stock market is going to be forward looking, so you have the peak over here, and then, we start seeing a decline because they're pricing in the recession. Okay. And then we actually bottom before the recession ends because now they're forward looking and they're looking, and saying, hey, well, the recession looks like it's about to end sometime soon, maybe in the next quarter or two. So, now we're going to start rallying again. Right. And that's kind of how you see things rotate into the market. Another thing that's really been driving, this rally, all right, has been the drop in CPI. Now, when you look at things like core inflation or sticky inflation, okay, like the core CPI and things, you're going to see a different chart. But when you look at the US CPI on a year-over-year change, what's really amazing is that, the pace that we declined, all right, is actually greater than the pace that we rose here on inflation. Okay, it took 11 months to get from 5.3 to 9.1, and then it took 11 months here to get from 9.1 to 4.9. So inflation actually, whether it seems like it or not, has been dropping lower, or it hasn't necessarily been dropping lower, but it's been falling faster than the inflation was going up in the past, in the previous 11 months, which I thought was really, really shocking, right? And you can see this a lot more in the PPI here. All right, you can see in 13 months, it went from 6.5 to 11.7. And then in 13 months, it went from 11.7 down to 2.3. So you're seeing these really dramatic changes. And one of the big narratives was that after China opens, it will export inflation to the US. And what we're seeing is actually deflation. Okay, this is China's CPI, year over year change. So, that's definitely something, to consider. Now, will inflation come roaring back? It's always going to be a possibility. One misconception people have about inflation is they think that as inflation comes down, prices are going to go back down. That's not the case, right? That's not inflation, right? That's, something different. All right. When you start seeing that, that's when you really start to run into a problem, right? And one way to realize this is, throughout this inflation, a lot of people have been getting raises. Your raises aren't going to get taken away because inflation's coming down, right? So that right there should kind of help, visualize it for you guys, or paint a little bit of a better picture. Is, you're not going to start making less money because prices of things have stopped going up at such a big pace, right? That's all what inflation is the price continuing to go higher month over month and year over year, not, is the price actually going down? So when you're seeing inflation dropping and inflation data dropping, what you're seeing is that it's just the pace that it's going up is decreasing, right? It's not increasing at such an exponential pace anymore. All right. Now, amount of money in market accounts, in money market accounts, is fuel for an equity momentum market move. And this is kind of what I explained in the very beginning of the video. What we see here, all right, if we dive into this a little bit more, okay, we can see here that the keyword bull market is soaring. Okay, it's broken a trend, right? If you want to be a technical analyst and draw a trend line here, see, it's broken the trend, it's breaking out. All right, and we're seeing lots of people now searching for the term bull market, right? And that's the whole thesis right now, is there a new bull market? Are we in a new bull market? And this right here is what they're speaking of when they're talking about a huge amount of money in money market funds. That's going to be a boom to the stock market. As I mentioned before, many people are actually underweight stocks. Okay, in the very beginning of the year, it was, hey, do you want to take risk-free 5%, or do you want to risk possibly 20-30% to the downside? Now that the market's seeing 20-30% gains to the upside, everybody with their safe, secure, risk-free 5% is probably really frustrated, right? And that's something, a little bit difficult to deal with. You can't be mad at yourself and the decisions that you make. You have to live with those decisions. And, if it helped you sleep better at night 6 months ago, you can't shoot yourself in the foot for it 6 months later when the market has rallied, right? It could have went the exact opposite way, and the market could have been, crashing down a lot. But as I mentioned, as these T-bills start to expire, and as people start to pull money out of these money market funds, you're going to see, I think, a rotation into the stock market. And I've already dropped a really good video going over an entire plethora of data showing you guys, all of the data really suggests that we are going to finish the market higher, and that we definitely are in a new bull market, at least for, this year. Does that mean we can't see a 5% drop or a 10% drop? No, of course not. I think that would be really healthy. I would honestly welcome that, versus chasing so many things at, really overbought levels. So that's going to summarize today's video. All right. I just dropped a very, very good video on TLT. If you're looking for some TLT info and data, I've got a really good one. Okay. And TLT may be due for a little bit of trouble. All right, because of the debt ceiling deal. All right, I've highlighted this in a few videos, but I actually dropped a dedicated video just going a little bit more in depth and, clearly explaining it to people what's going on after the debt ceiling, and, how the huge amount of treasuries that are being pumped into the market could be causing a liquidity crisis, not only in the stock market, all right, but really in the bond market. And it could cause things like TLT to drop And I, explain all of that very clearly. So if you enjoyed this video, you're definitely going to enjoy that video. And thank you guys for watching. Feel free to always email me at exactlytrades@gmail.com. You can email me some questions, some ideas, different things like that. All right. I try to respond to people's emails. I also do one-on-one coaching sessions. If you guys are ever interested, we can do a nice coaching session via Zoom. Just email me and we can try to work on setting up a time and a date.